26, with a 1-month drawdown of roughly 14 to 15%. Market cap still near T, normalized PE around 25 to 26, price sales just under 10. Support resistance short term, statistical support near, resistance around. Last quarter, revenue about B, up 16 to 17% year-Y, with strong Azure cloud growth and solid earnings beat. So the stock is correcting mainly from a rich valuation and factor rotation, not from a broken business. How I think about it by bucket, I'd lean toward adding gradually, not going all in. Thesis check. Cloud and Azure still compounding at high 30% growth. Microsoft Cloud and Microsoft 365 continue to drive most of the revenue expansion. Balance sheet, margins, and cash returns, dividends plus buybacks, B last quarter, remain robust. Risk management plan I'd use, define a max allocation to MSFT, for example 5 to 8% of total portfolio, depending on your risk profile. Scale in via 2 to 4 tranches, e.g., buy some around current levels, another if it trades into low S near support, and another only if fundamentals still look intact on further weakness. Pair with broad index or value exposure so you're not just long mega-cap growth beta. For a high-income, long-horizon investor, this drawdown looks like a reasonable opportunity to nudge allocation up, provided total tech AI exposure doesn't dominate your net worth. I'd mostly hold and tidy. Reasons to hold. Fundamentals and earnings trajectory are still aligned with a long-term compounder story. The multiple has compressed from peak levels, but is not distressed. It's a typical re-rating after a hot run. Portfolio cleanup options. Trim if MSFT is an outsized portion, say 15 to 20% plus of equities, to reduce single-name risk and redeploy into uncorrelated assets, value, international, small caps, or your preferred safety plays. Use options only if you're sophisticated. Covered calls slightly RTM to generate yield while you hold, or collared structures if you want explicit downside bounds. The key question, if you didn't own it today, would you want exposure at this price and business quality? If yes, that's usually a hold, or light add, not a sell. I'd wait with a plan, not pure FOMO. Let price and volatility settle, see if it can base above that near support area for a few weeks, or reclaim a prior resistance level with volume. Tie entries to fundamentals or events. Next earnings. If cloud and AI workloads keep growing and margins stay healthy, a post-earnings pullback can be a cleaner entry. Macro. If rate expectations or broad tech sentiment swings again, you may get even better risk-reward. You don't lose much by demanding confirmation in a $3 trillion name whose story will play out over a decade, not a quarter, or waiting. Personally, given your background and likely long horizon, I'd frame it as buying, accumulating. You want long-term compounding from a dominant cloud AI platform business. Your tech AI sleeve isn't already overloaded. You're comfortable with another 15 to 25% downside in the medium term without flinching. Holding. You're already allocated at or slightly above your target weight, but still believe in the 5 to 10-year story. You prefer to let the current repricing play out without adding more capital. Waiting. You're fully loaded on mega-cap growth or worried about macro valuation more broadly. You'd rather buy only on clear stabilization or deeper value, e.g., a forward PE in the very low 20s or below, depending